Prathamesh, you are on mute.
Yes, I'm audible, Kavita?
Yes, yes.
And video?
Yeah, video is also on.
Okay, thank you very much. Okay, good morning everyone. Good morning to all the participants. My name is Prathamesh Malia and I'm a part of AngelBroken Commodities and Currencies Research Team. Today we will have this webinar for the participants wherein we will talk about commodity markets in totality, and we are delightful to have collaborated with MCX, and MCX is reasonably helping out to help us all the clients in understanding commodities market. The webinar would be started by Somesh. He is a part of MCX team and he has in all more than 16 years of experience in the commodities market, and he would take you through all the products, features, participants in the commodities market, the commodity derivatives market in totality. So over to you, Somesh. You can take this forward, and this webinar would be in two parts. The first would be taken by Somesh, and then it would be the price perspective of commodity would be taken by me. So yes, thank you very much for this, Somesh. Over to you.
Thank you so much, Prathamesh, and very good morning to everybody. Delighted to have you on Saturday morning, and hope we are able to pass on the required knowledge that would you be required to you to start investing or trading in commodities. So, as informed by Prathamesh, that for the first set of presentation, which is around 15 to 18 minutes, will be taken by me, followed by a presentation from Prathamesh on the price guidance. So, I am Somesh Vaidya from MCX. I look after the business development for the entire Maharashtra region. And today, what we are going to inform you about how commodity derivatives have evolved over a period of 17, 18 years, and how has the regulation helped in launch of new products, and how the participants have fared in last few years in taking commodities as a very important asset class for making investment decision. So as we know, what do we mean by commodity is everything which we can have a look, we feel, we see, we consume. So it's a commodity in itself. So when we talk about wheat, which we eat on a daily basis, is a commodity. When we talk about sugar, we eat on a daily basis, that's a commodity, right? And we know that when we talk about commodities, we generally refer to the inflation, because if the price of the commodity is rising, there has been inflationary trend in the country, and which sets how inflation is going to fare, right? So commodities per se is a very important determinant of the economic activity in the country. So apart from the agricultural commodities, when we talk about metals, that's where the actual commercial production of the country, of the factories, of the manufacturing activities takes place. And any price volatility in those segment, we see the prices of raw materials increasing, right? When we talk about commodities like gold and silver, which India is totally an import dependent country, so prices depend on international markets. Any fluctuations or increase or decrease in pricing in these commodities have an impact on the price in India. And on the energy segment, we have commodities like crude oil and natural gas, and we know how crude oil an important commodity is when we talk about the prices, because the raw crude oil price movement is dependent upon the final output of prices of commodities like petrol and diesel. We have seen in last 1 year how has the prices of both these commodities increased just because of the volatility, keeping aside the taxes which the country and the state levies. But the basic raw material, which is the raw crude oil, the prices have been quite volatile. So the thing is that commodity space itself is a very important space for a person to learn, to know, to understand, a must have in a portfolio for investment purpose. And it is the real price of the commodity which drives the economic activity of the country. So with this short note, let me start with the today's presentation. So when we understand the financial market of a country, typically we know we have capital market, which is the share market, which we generally refer to. We have debt market, wherein bonds and government securities are traded. We have a very big currency market or the forex market, and then we have the money market, which is the market for overnight liquid money. Uh, if you see correlation between each of these markets and a commodity market, somehow or the other, they are linked to each other. So the commodity market has the prices of commodities has got an impact because of the actions or reactions in different markets. For example, take example of forex market. India imports crude oil, India imports gold, India imports silver, India imports other base metals. What if the price of US dollar, which is the benchmark currency for international trade, goes up and down from say 74 levels to 76 levels or 74 levels to 72 levels? The landed price, the imported price of the commodity is going to change, because if the price of the currency goes from 74 to 76, the commodity price is going to, the landed price of the commodity is going to increase because there is an increase in the currency, right? When we talk about debt market, any changes in the international interest rates, whether on the upside or on the downside, has got a severe impact on the US dollar, on the dollar index. And any change in the dollar index has an immediate impact on the commodities market. Generally, the debt market and the commodity markets are inversely related, which means if there is an increase in the interest rate of by the central banks of the countries, the commodity prices tend to go on a lower side, because your cost of carrying the commodity of for purchasing goes higher because the interest rate has increased. When we talk about capital market and commodities market, we know that commodities market, if there are companies listed on the capital market and are linked to commodities. Take example of base metals as a classic example. In the last 1 year, where we have seen a tremendous increase in the prices of all the base metals, be it steel, be it copper, be it nickel, zinc, and just relate it to the prices of the individual base metal companies. Tata Steel, Hindalco, Vedanta, we have seen an increase and surge in the share prices. Why? Because the price of commodities have increased. Take example of crude oil, which has increased, and a resultant increase in the share price of say Oil India or ONGC. So the point is that commodities market, and when we talk about money market, it's all about the money, the liquidity available in the market. Wherever the higher the liquidity, whether it's going into capital market or it's coming into commodities market, it's all game of liquidity, whether a person is able to purchase the commodity and store it for consumption or investment. So the idea to inform you is that commodity market is an important subset or an important linkage to the financial ecosystem of the country. So when we talk about equity market, we know the prices of shares are driven by good financial numbers. Prices of shares are impacted by good decisions taken by management in terms of diversification into new areas, new revenue growth, higher consumptions, higher sales. So basically, it's all about how is the company performing with respect to the return on capital employed and so on and so forth. But how are the prices of commodities impacted, right? For example, take any commodity in hindsight and see whether it has got an impact in India. So when we talk about commodity, let's have in background that we are talking about India-centric commodity and how those commodities are having an impact due to international references also. So crude oil, any changes or any volatility in prices in the international markets, the price of crude oil or price of any imported commodity in India, it's bound to increase or decrease, because India is a consumption-driven economy. India is an import-dependent economy when it comes to crude oil or gold or silver or even base metals to that extent, right? So any changes in prices in the international market going to have a bearing on the commodity prices in India. Forex rate, I already explained you. Geopolitical factors, be it global or Indian, it has got an impact on the commodity prices. For example, any news or any decisions by OPEC or OPEC Plus with respect to the oil markets is going to have an impact on the production numbers of oil in those countries, and a subsequent impact on the commodity prices, which is the crude oil. As far as India is concerned, we know that we are an agrarian country. Any decision by the government to have, because of the geopolitical significance, it has an impact on commodity prices. For example, yesterday or day before yesterday, the government decided to have stock limits in pulses. So हम जो pulses खाते हैं, be it a chickpea or be it a black gram, government decided to have stock limits in those commodities, which means that a trader cannot hold beyond X quantity in its warehouse, right? That's going to have an impact because of the restricted supply and demand remaining the same. So it's going to have an impact on the commodity prices. What are the trade policies and regulations? The import regulations which a country has, India has with respect to the other countries. Economic factors, extremely important. Everybody learned, would have read in last 1 year how the lockdown, when it started, airline industries was shut literally. There was no economic activity. The crude oil prices went negative. When gradually the lockdown was opening and unlock started, economic activity started, and we saw how consumption started, and that's where the prices of crude oil started to gain again based on the demand in the economy. Classic example, agri commodities, the consumption was pretty high. We had a decent monsoon, we had a decent stock available, but still we saw the prices of agri commodities going on a higher side. Take example of base metals to that extent. So all the economic conditions in the economy, be it a recessionary trend or inflationary trend, which we are passing through right now because of higher commodity prices, commodity as a super cycle, which we have been reading a lot these days, has an impact on overall commodity ecosystem. And what's the trend in fast growing economy? As I told you, India being a consumption driven economy, commodities are a very important aspect. And what are the specific events or statistical releases with respect to the demand and supply of the economy? It's extremely important for us to understand whether the commodity is going to have muted demand going forward. Take example of aluminum. We all are talking about electric vehicles of late since last 1.5 to 2 years. And if that's the vision that we need to have electric vehicles by 2030, then aluminum is going to be the key commodity, because a lot of aluminum is going to be consumed in manufacturing of electric vehicles, right? So demand of aluminum is going to increase, demand for other base metals is going to increase, and we know the supply scenario. In spite of production, we still import a lot of aluminum or other base metals from international markets. And what are the inventory levels? Do we have a carry forward stock? For example, government procures wheat at a minimum support price. Whether the inventory levels are sufficient enough to feed the entire country for the next 1 year, or the inventory levels are low because there were bad monsoons, there was no production of wheat, or there was production but not to that extent. So all these statistical data are extremely important for us to assess whether the commodity is going to have excess of supply or excess of demand, based on which the price of the commodity, the economists say that the price of the commodity is going to remain on the higher side, or it's going to remain neutral, or because the supply is more, the commodity prices may tend to go down. So these are the key factors which impact the prices of commodities. And this, believe me, this information is easily available across the social media or across the websites. You do, and you get a lot of information. So I always say that there are 4 P's for a market platform. most important one with the platform for which is offered to you to invest and trade. So commodities market trade from 9 a.m. till 11:30 or 11:55 in the night during the US twilight. So why do we trade such extended hours? As I explained you previously, that India is dependent upon international market for internationally price referenced commodities, be like bullion, like base metals, but like energy segment. And since we need to have an arm's length price across the markets, we are a price taker. We are not the price setter for those commodities. As a result of which, since international markets are open beyond evening time, the commodities market are also available for trading for extended hours. The second P is the product, or what products are available for participants to come trade, invest, or hedge. We have, I would say, three products. Sorry, futures contracts of individual commodities, options contracts on futures, and then we have index futures. So what do you mean by futures contracts of individual commodities? So we have predominantly bullion, which is like gold and silver. We have base metals, which is the 5 key base metals like aluminum, copper, lead, nickel, zinc. Energy, we have crude oil and natural gas. Recently, last year, 10 months ago, we launched indices on bullion, which is gold and silver, indices on 5 base metals, and then we have agricultural commodities. So the next slide, I will explain you what is the commodities available in detail for trading. Then post SEBI becoming the regulator of commodities market, they permitted a lot of participants and a lot of new products also. So first of them was the options on futures. So today we have gold, silver, crude oil, copper, and zinc options, of which I would fairly say that crude oil is the most liquid options contract and easily tradable. I would say low cost investment to enjoy the volatility in commodities. And then we have indices, like you have Nifty, you have Bank Nifty, you have Sensex, which comprises of certain components of shares like 50 shares or 30 share index. We have bullion index, which comprises of gold and silver as components. Metal index, we have 5 base metals. I'll explain you on the later slides. Participants, so the third P, who are the participants? People like you, be it day traders, be it investors. We have hedgers, or the physical market participants who are exposed to commodity price risk. They are the opposite participant to what the investors or the institutional participants are. We have arbitragers. These are the people who normalize or balances the price difference between two markets for the same commodity. So for example, the price of gold in one market is say 100, and price of gold, same gold in another market is at 110. So these arbitragers would take a long position in one market and short position in another market, or a long position in one futures contract, a short position in another futures contract, and try to normalize the price difference. And then we have a key important market participant by name of farmer producing organization, FPOs, mainly in agricultural segment, who come hedge on the exchange and also have a scope of delivering the commodity through the warehouse ecosystem. And last and most important, I always say, is the policy decisions. What are the regulatory policies for the overall development of the commodities market? So as I said, when SEBI became the regulator 4 or 5 years back, the policy decision regarding client safety, policy decision regarding client margin requirement, new products like options and indices, new participants like mutual funds, AIFs, and PMS in commodities. So these are all the important developments which has the regulator has introduced for overall development of the commodities market. So SEBI has notified roughly 91 commodities in which futures contracts or the derivative contracts may be launched by exchanges. So presently we have 4 segments, as I explained: bullion, energy, metals we have, and agricultural commodities. All these 4 segments, diverse segments, each representing a segment of commodity consumption in itself, and these all are available for trading on MCX. So this is what the graph shows. What are the turnovers, and you can see on the pie chart that gold, silver account for a lot of volumes on the exchange platform, very easily relatable to Indian household. We consume a lot of gold, and that's why gold and silver are the prominent contracts on the exchange, followed by energy segment, which is crude oil and natural gas, and then we have the base metals. So why should we plunge into trading, investing in commodities? It's a game of leverage. So what do you mean by game of leverage is, should I go to Zaveri Bazaar in Bombay? I need to buy gold, say 10 grams. I need to shell out, say, 50,000 rupees. But I say that's a lot of investment, because ultimately I'm going to buy that gold, either gift it or keep it in the locker and even pay locker charges. So do I have an opportunity or an option available that for the same 10-gram gold, I go somewhere else by paying a lesser amount? So that's where comes the role of the futures market, where you don't pay the entire money, 50,000. What you pay is roughly a 10% margin. So this is what an important slide is, in nutshell, about the products, the margin requirements, the contract sizes, etc., etc. So when we talk about the first few lines under the segment bullion, so we have products ranging from 1 kg gold, approximately 48 lakh rupee, to a product like gold petal, which is a 1 gram gold, ranging rupees 4673. That's the roughly price, right? But you don't have to shell out. It's not a spot market, it's a derivative market. What you need to shell out is roughly 7.5 to 10% margin to trade, to buy or sell these contracts. So if I am a retail investor, a small investor, and my risk appetite is to buy 8 grams of gold guinea, which is a coin, I don't have to shell out 38,000 rupees. I just need to have roughly 22,000 rupees margin to be given to AngelBroken to purchase one lot of 8 grams of gold guinea, 340 rupees roughly for 1 gram of gold petal. So this is what the leverage is. You don't shell out the entire money, you just have to pay the margin money. When we talk about silver contracts, you see that we have a silver micro contract, which is a 1 kg contract. If you go in the physical market, you pay 70,000 rupees, but you pay only roughly 8,000 rupees to buy 1 kg of silver. So what technically you are doing is, you're still buying a contract, but not a physical contract, by paying a small margin, and you're fixing a price of a commodity. That today I entered into a contract to buy silver at 68,934. And you feel that, okay, fine, I'm good to go, I don't want to take delivery. You pay 8,000 rupee margin to a broker. Prices fluctuate up and down, and that's how you lock in your price. If you have a capacity as an individual participant to venture into deliveries, there is a scope of deliveries also. So all the contracts in bullion segment are physically delivered on the last 5 days of the expiry of the contract. Now, last 10 months ago, we launched an index which is derived basis the price of gold 1 kg and silver 30 kg contract, a cash settled contract with margin requirement of roughly 50,000 rupees. The beauty of this contract is it's derived basis the price of gold 1 kg and silver 30 kg contract, which means that whatever is the volatility in gold 1 kg and silver 30 kg contract, uh, that volatility is captured in the index itself. And that's how you enjoy the benefit of gold and silver both put together, right? So you don't have to worry of delivery, you don't have to worry of individual commodity concentration, but using an index of gold and silver put together, you are able to take the price benefit or the volatility benefit of both the commodities put together. Similar is the case for base metals. If you quickly have a look at the base metals, the metal index is derived basis the 5 base metals: aluminum, lead, zinc, copper, and nickel. So if you feel that a nickel contract is a 20 lakh rupee contract, having margin requirement of 2,25,000 roughly. Same is copper, same is zinc, lead and aluminum having a margin requirements of roughly 1 lakh rupee. Instead of that, I wish I'm a trader who understands base metals very closely. I need, instead of having one single contract, I wish to enjoy the volatility of all 5 base metals together. Then I will plunge into metal index by paying just 50,000 rupee margin. So essentially what I'm doing is that I'm able to enjoy the volatility of base metals. I'm buying one single contract of index, and that's how I'm able to diversify my portfolio of not buying 5 individual contracts, but then metal index. So index trading is more of a portfolio diversification, a portfolio-based approach to investment in commodities. Energy segment, we have natural gas and crude oil, the most two volatile energy contracts across world, I would say. And then in agri, we have got cotton, we have crude palm oil, which is the most liquid contract, followed by mint contract, which is mentha oil, and then we have kapas. So this is what the game of leverages. Instead of not paying a full contract value, you are just paying a margin amount ranging between 7.5% to roughly 12% across the commodities. Then we talked about liquidity. Liquidity is the contracts which are most liquid on the exchange, which I showed you previously on site, that gold, silver, crude oil, natural gas are the 4 big liquid contracts on the exchange. Then we talk about diversification. This slide would clearly show that both gold, which is an easily relatable and understood commodity since ages, has got an inverse relation with equity market, and that's fairly understood because when the liquidity is largely into equity market, we see that Nifty has been jumping highs every day, right? The gold has got a muted demand. That's quite understood. So, but when there is a fall in a financial market or the capital market, the liquid funds, the money, as gold considered as a safe haven investment when the situation is bad. In early January, when we were, getting into the COVID situation, March, we saw a big fall in financial markets, and that's where the prices of gold shot up tremendously from roughly 37,000 per 10 gram to a high of 55,000. But then when the liquidity again started to enter equity market, you could see fall in gold prices. So we can fairly say that gold being a portfolio diversifier, as an hedge against inflation, as a hedge against the economic conditions of the country, it has must have in any investor's portfolio, apart from the entire money being parked either in equity markets or fixed income instruments. And another example of commodity being, an asset class. We had done a study sometime back with IM Cozy Code, wherein why commodities should be included in an investment portfolio. On the left-hand side, you could see that bond markets for the period of 10 years gave a return of approximately 7.2, and with risk of hardly any risk. That's quite understood. But when we talk about large cap equity stocks or mid cap equity stocks or foreign equity stocks, which a lot of people have recently started to offer, look at the Sharpe ratio of foreign equity. What is Sharpe ratio? Is basically risk adjusted return. How much your portfolio has a risk, and over and above that risk, how much return that particular asset class is given. That's the Sharpe ratio definition, right? So you could see gold. It has given, it's got a risk of 14.5%, but a return of 9%. But if you see on the right-hand side as a sample portfolio, if you have NASDAQ 100 stock index with you, you have bond, you have gold, you have aluminum, natural gas with you, with weightages given on each side, you could see that with commodities included in your portfolio, along with gold, along with bond, along with equity, your return is on a decently higher side when you increase or decrease the component of your weights for your asset classes, which shows that that commodities is a must have as an asset class for any investor to have in its investment portfolio. So we talked a lot about futures. When we talk about options, everybody, we know options is a simpler way, a low cost way to trade volatility of a commodity. Take an example of crude oil. If I feel that the crude oil prices are going to be volatile, and if you feel the prices are going to go high immediately or go low immediately, either ways, right? And you feel that buying futures contract, it's costly affair. But if you are sure short of prices being volatile on a single day, options are the products. And what do you mean by prices being volatile on a single day? Options are contracts. They are cheap contracts to trade, but the premium which a buyer of an option contract, you buy either a call option, that is, you think that price of crude oil is going to go high, you buy a put option, you think the price of the crude oil is going to go low. The premium is decided on the expiry date of the contract, the number of days to the expiry, the value of the commodity itself. That is, the writer of the option gives you, I am ready to write an option at particular premium amount, right? And that's where the options on futures are an important medium to trade volatility. So we have 5 option contracts right now, and very soon in third week of July, we are going to launch silver mini options also, options on silver 5 kg contract. So presently we have gold 1 kg and silver 30 kg contracts. So these are contracts on the expiry. If you are in the money means you have bought an option and at a strike interval of say 45,000 for gold, and the price of gold on the expiry is 47,000, you are already making money. In the money means you are making money. So you have an option to convert your option contract into a futures contract. That's what we call as devolvement. I'm not going into the technicalities of commodity options because it would require a separate session on it. But just to give you a bird's eye view of what contracts are available. So we have gold, silver, which are contracts with option of devolving the in the money contracts into futures. Crude oil, a cash settled contract, absolutely no concept of delivery. You want to punt on the volatility price of crude oil, and that's the contract you should focus on. In fact, 2 days ago, exchange recorded highest volumes in crude oil options, roughly 3,500 crores on one single day since launch. So why? Because crude oil, we know prices are volatile these days, and it's a low cost way to participate. For example, even at in the money strike is trading at a 200 rupee premium, and the contract size is 100. What you pay is 20,000 rupee premium. So that's a fairly reasonable amount for an investor to start participating in commodities. And then we have copper and zinc contracts also. As I repeated, silver 5 kg options will be available somewhere in third week of July. So these are some of the terms used in the option segment. I'll share this presentation with you. You can have a look at it. Then we have third subset of product. I would say it's ultimately a futures contract only, but then we have termed it as an index futures for better understanding. So what is basically an index? So index, we have 2 sectoral indexes. One is the bullion index and another is a metal index. If I need to relate it, you have Bank Nifty, which is comprises of all the banks having weightages, how much weight ICICI Bank would have, how much weight SBI would have, how much weight HDFC would have. The weights are decided based on the market capitalization of those individual stocks. In our case, the weights are decided based on the volatility of underlying gold and silver contracts, the volatility of underlying base metal contracts, and the size of the physical market. How much is the size of the physical market? So we took December 31, 2015, having base value of 10,000. So this is no rocket science. This was a mutual discussion between the exchange and the regulator, and we came out with a base value of 10,000. For example, somewhere previously when the equity markets or when the index trading would have started, Sensex would have some base number, right? Would be 100, would be 1,000, I don't remember, but we need to start somewhere, correct? So we have this base value of 10,000, and that's where the bullion index was launched. Kindly allow me 1 minute, please. Kindly allow me.
All good, Somesh?
I'm sorry. There was some internet issue. I'm so sorry.
You can see your screen.
Can you see my screen?
Yes, yes.
Okay, thank you.
Gold,
So,
Bulldex.
yeah, bullion. So this is what index is. We have bullion index, which is derived out of gold and silver futures contracts. Gold futures having 66.6% weight and silver as 33.40% weight, which means that if you feel that gold prices are going to go higher as compared to silver prices, but silver still will be going higher. Normally, we have seen that. So you can easily start investing or putting your money in index comprising of gold and silver contracts, because ultimately both these gold and silver contracts have derived prices from the individual gold futures and the silver futures, right? Similarly, we have metal index, which is derived from aluminum having 12.11% weightage, copper 34.55% weightage, lead 5.36% weightage, nickel 31.77% weightage, and zinc 16.19. So don't bog down by these numbers. These numbers are the weightages derived basis the volatility of individual base metal and the size of the production of each individual. So rather than thinking of putting money in either of the individual base metals, is always have an index which will represent the entire industry, and that's what base metal index is all about. So why should you trade an index futures? Basically avoid single commodity risk going high or low on one side. It normalizes the volatility, right? It trades a sector in itself, the segment in itself, be it bullion or base metals. It's a small size contract, roughly around 8 lakh rupees. Most importantly, cash settled contracts having lower margins. Instant diversification, rather than putting your money only in gold or silver or any of the individual base metals, you can diversify into segment by buying an index. And probably it would also, once you become a seasoned investor, you can have your own strategies of buying index and individual contracts of bullion if there isn't any opportunity available or price difference between those contracts. We have a super liquid underlying gold and silver 30 kg contract, very low break even, around 3 to 4 ticks, 2 ticks for a proprietary trader, and we have a very efficient price discovery because the underlying contracts are fairly liquid. So this is how, again, two indexes have fared. We have seen base metals and bullion index, both are inversely related. As we saw previously, how bullion and equity index was inversely related, out here also bullion and base metals are inversely related, which gives a fairly good chance for you to diversify your investment. Whenever you feel index is not, bullion index is not good, doing good, have a look at the base metal index. And bullion index and equity, same like gold and silver, are inversely related. So commodity as an investment, this is what we have shown you. This is from my side. We'll take up the question and answer session once we are done with Prathamesh's session. Thank you.
Thank you, Somesh. I think there was a whole lot of information with regards to the basics of commodity market, the products, the participants, and yes, future metal index options as a hedging and investment tool. Possibly a whole lot of information is given by Somesh. So I'll start my presentation. It will be a short presentation of 10 to 15 minutes. I'll share you about price perspectives and what are the dominant factors that is happening in the commodities market. So can you see my screen? Just a second. Can you see my screen?
Yes, Prathamesh, your screen is visible. Can you make it full screen?
Yeah. Okay. Yes, so we'll talk about commodities as a macro picture. What are the dominant factors that are in consideration for the rest half of 2021? For the first half of 2021, commodities has been a very volatile story, and we'll talk about what are the factors that has been in consideration and what are the likely factors that will dominate for rest half of 2021. So I'll just take you back to the history wherein the COVID pandemic stuck. I think most of the commodities, including energy, agriculture, metals, everything went to a tailspin. On almost all the prices of all the commodities started to fall. It created panic across all the global markets, whether it be equities, commodities, currencies, any asset class. So no asset class was spared because of the pandemic. So what really happened was all the prices of commodities started to decline, because of which panic created. And you can see the price of agriculture commodities also went to a tailspin, and which again created disturbances in the financial markets, and because of which the central bank had to step in, as in previous uncertainties, wherein the role of central bank is to bring about growth and normalcy in the economy. What central banks did this time is they infused enormous amount of liquidity. Simply putting it in easy terms, they infused a lot of liquidity in the economy, so that the economy comes back into normalcy and growth. So almost U.S. central bank pushed it close to around $3.5 trillion of injection, while European ECB pushed in almost 3.3 trillion injection. Japan also put in 1.53 trillion of liquidity. China also put in enormous amount of liquidity. So what this liquidity push really did was it inflated all the asset classes. As you can see, most of the asset classes, after falling into negative territory in April 2020, at the close of the year 2020, every asset class, including gold, silver, and rest of the commodities, had a positive momentum. While one commodity which did not fare very well was crude. It was but obvious because all the global economies came to a standstill, and they adopted a closed version of putting lockdowns into their respective countries depending on the pandemic. So yes, the effort of the central banks to bring in normalcy had resulted in optimism, and it resulted into a price increase across all the commodities. So this was the effect of central banks, wherein they had the liquidity push, which in turn resulted into positive momentum in all the asset classes. So we are in 2021, almost first half of the year, 6 months of the year is done with. The highest performing commodity in this particular commodity segment is crude. I think with the kind of normalcy that is seen in the recovery across all the global economies, starting from US, EU, Japan, China, India, opening up of economies, I think the pent up demand with regards to energy has clearly seen in the price of crude. The second best performer in this commodity segment is natural gas. This is a commodity which is very volatile in nature. But yes, April to October is nothing but injection season, and this commodity is a really a trader's paradise. So yes, commodities have performed fair bit in 2021. The role and effort of the central banks to push in enormous amount of liquidity has created a vibe of normalcy and vibrancy across global markets. So yes, taking into consideration the liquidity injection, I think this optimism is going to remain for rest half of 2021. Although you can see gold and silver as a commodity has not fared very much for the first half of 2021, we will continue to see how policies of the central bank in the coming months will define how gold and silver prices move in tandem with all other commodity prices. So this is a very important slide for you to understand if you're an investor in gold and silver also, wherein the blue one is nothing but the real the 10-year treasury mark, and the red line is nothing but gold price. Till the time the real yields, which is nothing but the difference of inflation and 10-year interest rates, I think it trades in a negative territory. Gold prices are possibly going for an upside from here on. Although the Fed in the recent monetary policy meeting has spoken about transitionary phase of inflation, till that time the QE or liquidity push continues to remain, I think the gold and silver prices as a commodity are possibly going to see a new highs in 2021. So yes, this is one of the important chart to understand wherein the difference between gold and 10-year treasury yields come into picture. So this was an update from a recent update from the Federal Reserve on June 2. This was nothing but an indication that the liquidity tap, which was infused by the Federal Reserve, in some way or the other, they are going to shut down this liquidity tap, taking into consideration the growth in the U.S. economy. So in some way or the other, if US is growing, I think the central bank's decision of pushing enormous liquidity has clearly played its important role. So yes, all these events, press releases from Federal Reserve are going to have an impact on commodities. So yes, we really need to keep an eye on the liquidity tap of central banks. Next, important not last but not the least, I think China's credit impulse is something wherein we need to understand from a commodity perspective. China's credit impulse has been really volatile for most of 2020, and you can see as a percentage of GDP, it is clearly falling. So if China doesn't grow, I think the role of base metals from a price perspective is also at risk. So in that case, China's credit impulse is slowing down, which clearly tells a story that the base metal price, which has increased for 2020 as well as 2021, is possibly going to take some bit of stride in the coming months. So we really need to have a look at what the central bank does with regards to People's Bank of China and other central banks to bring normalcy in the economy. So yes, this is nothing but to give you a trajectory of how China would possibly grow in the coming years. So as you can clearly see on the right side of this particular graph, the growth momentum would possibly slow down. If China slows down, I think the momentum in commodities would possibly slow down. So yes, fixed asset investment, again, this is an important indicator. Understanding that how China is putting its investment into fixed assets. So fixed asset investments are nothing but it is spent on real investments like infrastructure, property, machinery, and other physical assets. I think if this number is high, it really is a good indicator of how a greater future production would happen. So this number is really not happening well. I think there's a concern on how base metal price would possibly react in the rest half of 2021. So all in all, in totality, we have central bank pushing in enormous amount of liquidity on one hand. You also have China's credit impulse going down on the other hand. So till the time real yields are going to stay negative, I think the possible momentum for gold prices would possibly on the higher side. I think it is consolidating at gold prices in the international market, consolidating in the range of 1770 and 1800 mark. I think till the time all the central banks, including US, Europe, China, Japan, they continue to push in enormous amount of liquidity, we would possibly see gold prices to be on the higher side. For the rest half of 2021, I think $1,900 is what we foresee, and in rupee terms, it turns out to be around 4,000 rupees from current price levels. We can take the price towards 51,000 by the end of this particular year. As far as WTI crude is concerned, the return of normalcy, opening up of economies, and the pent-up demand and the decline of inventories and the actions taken by OPEC as a cartel has clearly resulted in optimism in oil prices. It remains to be seen how oil prices would possibly react in the coming months, depending on the decision of OPEC and its cartel to reduce or so to increase oil production. So yes, as far as at present times concerned, we are possibly in an uncharted territory. I think taking into consideration the momentum, possibly around 6,500 is what we see by the end of this year as far as oil price is concerned. And as far as copper is concerned, I think this commodity has been gaining a lot of momentum, taking into consideration the green projects that is happening in China and other parts of the globe. Although China's credit impulse is slowing down, I think we are almost confident of copper prices to be on much higher side in comparison to what we see today. I think the channel clearly says that copper prices are possibly in an upside range, and by the end of this year, I think 800, 815, 820 is possibly where we would see copper prices heading from the current levels. So that was all from my end, but let me tell you about our education investor platform, which is Smart Money. Just give me a moment. So yes, this Smart Money is powered by AngelBroken. It is an investor education platform wherein we tell all our participants and new participants in the commodity markets about the nuances of commodity market, right from beginners to investors to traders. So it is really a platform wherein the education content is superb, and you really can go into this particular website and take a stock of what are the information that is available as far as all the financial market is concerned. So we have different modules, chapters, podcast, video, glossary of all the key highlights of stocks as well as commodities market. So it is a good platform for investors to learn and enhance their knowledge with regards to commodities in specific and other financial assets. So yes, it is free. It is absolutely free. Of course, there is nothing big charge for learning. So this is a platform where one should take advantage of, whether you fall into any of this category, beginners, investors, or traders. I think there is a lot of information that is being shared for enhancing the knowledge of investors in this particular financial markets. So yes, that was all from our side. We can take Q&A from the participants now.
Prathamesh, there was a question in the chat box. Natural gas options trading is available in coming days. I would say hopefully yes. There are certain regulatory requirements that we need to fulfill. Hopefully we are towards that particular fulfilling those requirements, and you would soon, not soon, but you would have in few months natural gas options trading. That's number one. And number two, what is the minimum amount to invest in this index is another question. So as I explained to you, that's the margin money. So if the contract size is say roughly 7 lakhs and the margin is 6%, what you need is around 42 to 45,000 to trade in both the indexes. So under 50,000 is what is the margin requirement for index. So do we
Okay.
have any other
Uh,
question?
will you share the presentation with us, sir? This particular webinar was live on YouTube. You can just type in the key, the name of this webinar, and you will get this link. Also, the link will be shared to the clients. So yes, this is stored on the internet, and we
I'll
have
share the
some
present.
questions.
Yeah, I'll share presentation with you. Also, I am on the YouTube channel and trying to figure out if there are questions out there. Nothing as of now. So the question from YouTube: How volatile is natural gas? Pratmesh, if you can
Naturally,
take this up. Yeah,
can I answer that question?
sure.
Okay, natural gas as a commodity is a trader's paradise. I think this is a very volatile commodity. If you get on this commodity, I think you can mint money in this particular commodity. But yes, volatility is certainly a part of this particular commodity. So if you're really carry forwarding your natural gas positions, I think you are at risk. So if you really are a risky trader and who wants to make money, I think possibly natural gas is for those people who want to take a risky bet.
Is margin requirements after September is another question. So in my presentation, I had showed you one slide having the entire margin requirements, right? So pretty much based on the price of the commodity, if those are the ones in September, then the margin requirements would be accordingly, calculated.
There's one more question: is any margin changes after September since intraday becoming delivery?
So I didn't understand the second part of the question, but there are no changes in the margin requirement. As I said, you have to shell out the entire margin to trade commodities. What do you mean by entire margin? It's not the entire 50 lakh rupee to trade gold, but if 50 lakh rupees is the contract value and roughly 10% is the margin requirement, then 5 lakh is what margin is required to trade in gold big contract. If once I share my presentation with you, you can have a look at that slide which shows the margin requirements, and you can fairly assume that would be the requirement if the prices are those at current levels in September. That would be the margin requirements.
I
Could you
think that was
organize a webinar on crude and index futures and options? Pretty much, yes. We will discuss with Angel, and we will have a separate session on crude options and index futures separately. That will be taken up.
that is certainly on the pipeline. We are having a lot of sessions. We would be having a lot of sessions with MCX in collaboration, and we would specifically target different set of products that are available to trade right from options to futures. So yes, we will certainly have it in the near future. So
I
I think
think
Sumesh, we have answered almost. Uh, what is the minimum amount to trade in crude oil?
it's if it's price, it's 20% is what the margin is. So roughly around 1 lakh 10, 1 lakh
1 lakh.
20,000,
Yeah.
approximately 1 lakh 10,000 rupees.
Yeah. So I think we have answered almost all the questions from the YouTube as well as from the Zoom question box. I think we can possibly wind this session.
Yeah, there's one last question which I'll take it up. Are
Yeah.
there FIIs, DIIs traders also in MCX market? So FIIs are not permitted to trade in commodities yet, but there is something going around discussions are on how they can participate. As far as DIIs are concerned, there are three set of participants which are permitted to trade. One is the mutual funds, one is the alternative investment fund, and third one are the portfolio managers, the PMS, right? So these participants are allowed to participate in commodities. I think
So
we are done with
yes.
all the questions.
Yes. So thank you very much to all the participants attending this webinar today. We will continue to have such webinars in the coming futures, targeting specific products that are available on the M6 platform. And yes, it was a delightful session with all of the participants, with all the question and answers. And thank you very much, Somesh and MCX, for having collaborating with us and informing all our clients and participants with regards to nuances of commodities market. Thank you very much. We wind up this session for the day.
Thank you, Pratmesh, and thank you, AngelBroken, for giving me this opportunity. Hopefully, we'll be able to pass on such bearing sessions to participants so that they can come and participate in commodities. Thank you so much.
Thank you so much.
Thank you.
Thank you, Prathamesh. Thanks, everyone.
Thank you, everybody.